Hello and welcome to our week 4 online video. This will help you be able to complete that table that is uploaded to Canvas. And it compares perfect competition with monopolistic competition, oligopolies, and monopolies. So, it's going to highlight the differences between the two. Just like yours, mine has the perfect competition already filled out since we covered that last week, but we'll still talk about it a little bit. So first, the number of buyers. In perfect competition, there are many buyers, and there are many in all the others as well. So that means that in all 4 of our market structures, there's lots of buyers, and no one buyer has any more control over the product and their demand for it than another. So the book mentions monopsonies briefly, not monopoly, but monopsony. Excuse me, it's very hard to get the difference out. And so a monopsony is a monopoly buyer, meaning there's only one. It's just a special subcase. But most of ours that we observe in the real world are more in the supplier side is the difference, and they show many buyers. So that's most of what we focus on in our class, since it's a very condensed time period. So, moving on to the number of sellers. Monopolistic competition also has lots of sellers, so maybe not quite as many as a perfectly competitive firm, but there's still lots of people producing this. An oligopoly has very few, usually only 3 or 4. You could easily list all the producers who produce a product when it's an oligopoly market. And then a monopoly, since mono literally means one, we only have a single unique producer of whatever this good is. A lot of times the reason there's only a few producers has to do with the barriers to entry. So with perfect competition there were pretty much none. You'd have to fill out some paperwork when you think of the farmer case, but there were no legal or technological disadvantage to opening up your own farm. For monopolistic competition, there are some barriers, and a lot of that is going to come from the fact that a new firm will not be as successful as an existing one because your brand name has some value. And the same goes for an oligopoly, but usually there's even more protection of keeping others from entering the industry, so there might be some type of licensing product, so it's hard to get into this industry. So this would have substantial barriers to entry. And you may have chosen different words to explain roughly the same thing than I have, but as long as you're seeing that the number of sellers decreases as you go from perfect competition to monopoly, and the barriers increase. So there are extremely high barriers to a monopoly. There may be a legal mandate that only one person can do it, or it may just be such a costly of a thing to produce that you don't even need to keep other people out, that only one person will want to produce it. So the availability of information has to do with how well do the buyers know what the sellers are doing and what their options are. So with perfect competition, there's perfectly available information, right? There's nothing the seller can hide from the buyers. With monopolistic competition, there's slightly imperfect information. Meaning, again, we've got this brand difference, and the brand recognition of a monopolistically competitive firm may be because there is a difference between the product, or maybe because there's a perceived difference, and you don't always really know which is the case. So there is slightly imperfect information. And the same goes for an oligopoly. But then when we move to a monopoly, it is completely imperfect. We only know what the monopoly wants us to know about what they're producing. Okay? So in a perfectly competitive firm, like those farms we talked about, their products were completely identical. Meaning that you couldn't tell one farmer's ear of corn from another. Okay? Monopolistically competitive firms have differentiated products. Right? That means that again, this brand nameness is coming important. Okay? Because what they do is they try and make consumers see the product as being different. It may be all toilet paper, but Charmin is different from Cottonelle, which is different from Angel Soft, that sort of thing. Okay? And then an oligopoly could be either similar or different. So in some cases, oligopolies do try and differentiate themselves from each other, and then other times they may not. So in a lot of our columns, the oligopoly is kind of a black box. The only thing that's hard and true is that there are only a few people producing in this market. So all the other stuff we won't be able to describe in very much detail because it has to do with a section of economics called game theory, and it talks about the strategic interaction of the different firms, and without going into that, we can't really cover oligopoly. So a lot of it is going to be kind of a black box. Moving on to a monopoly. So again, a monopoly is the only one producing this good, so they have a completely unique product. So, we also discussed that perfectly competitive firms are price takers. They have absolutely no say in the price. They take whatever the market price is, because if they try and charge a higher price, nobody will buy it. They'll buy the other good that's the same at the lower price. Or if they try to charge a lower price, they'll sell out just like they would at the market price. They just leave with less money, so it's not worth it. Whereas for a monopolistically competitive firm, they do have some price setting abilities. Right, so they are limited based on certain factors, but they are able to choose their price to some degree. So their limitation comes in the formation of the demand curve for the firm. So then for an oligopoly, they are also a price setting firm. They have even more price setting abilities than monopolistically competitive, and then a monopoly is completely a price setter as well. So they have even more strength in their price setting abilities. So moving on to the market power. Perfectly competitive firms, an individual firm has no market power because they're such a small person in the whole scheme of things that any little thing they do impacts nothing at all. Whereas a monopolistically competitive firm has some market power. Right? So their power comes from the strength of their brand. Whereas there is no such thing as a brand for farmers. Okay. Then in an oligopoly, they have a good amount or lots of market power because there's only a few of the firms splitting the power for the entire industry. And then a monopoly has all of the market power because they're the only one doing it. So in your homework, you've got to calculate a 4-firm concentration ratio. I believe the question just refers to it as the concentration ratio, but that always means the 4-firm concentration ratio. And so since every firm in a perfectly competitive market is the same size, that means no matter what 4 firms we add up, you're going to get the exact same percentage of market share for those 4 firms. Whereas for a monopolistically competitive firm, we're going to get something a little different. So again, they have a little bit more market share. So if we sort the biggest 4 and we add up their market share, it's going to come to 20 to 40% of the market belongs to those 4 biggest producers. Right? And the 4-firm concentration ratio is always the 4 biggest producers. And then for an oligopoly, it's a much larger percentage, somewhere between 60 and 100%. So notice this isn't covering all the possible combinations of 4-firm concentration ratios. There's many other market structures out there. These are just the biggest 4. So given the accelerated nature of the course and the introductory level, that's as far deep as we need to go. But back to the oligopoly. So if there are only 4 or fewer firms in the oligopoly, which there very well could be, then clearly all 4 firms, or 3 firms if it's smaller, will maintain the entire market, so it'd be 100%, but it could be as low as 60 if you have more than 4 firms in the market. But again, they're considerable in size given the scheme of the market. And then, since a monopolist is the only one producing it, they alone have 100% of the market. So that takes us to the demand for each firm. So when we drew the demand for an individual firm in the perfectly competitive market, here we had the market demand and supply, and it gave us that equilibrium price, and the demand for the firm was just that price. Whereas if we look at a monopolistically competitive firm, they do actually have a downward sloping demand curve. And in fact, this demand curve is more elastic than the market demand, meaning they have something to substitute away to, so if they exert too much power, then the demand is relatively elastic compared to the market demand, so consumers will just leave that brand for another, so they can't forever increase their price. But it is still not perfectly elastic, like it is in the case of the perfectly competitive firm. And the height of this demand curve can be impacted by advertising. So the better their advertising, the more they might be able to draw people to their firm as compared to others. And oligopolies is a pretty big black box, but we do know that, again, they are more elastic than the market demand. They're more elastic than the market demand, but they are not perfectly elastic. And again, it can be impacted by advertising. Then when we look at the monopoly, their demand for their product is the same as the market demand, because again, they're the only one doing it. So the demand structure for these individual types of firms are very important for determining their equilibrium price and quantity, and so we will discuss that in the next section or the next video.